I'm John Cervantes, partner at Prime Capital Financial in San Antonio, and I'm joined today by Marilou Moursund, my partner. Hi, Marilou.
Hey, John.
You guys graciously offered me a spot on y'all's business, but you guys founded the business, the artist formerly known as CrossVault,
Yes.
in the early 2000s. But before that, how did you get started in the business? I know you're a chartered financial analyst, MBA. You went to UT. How did you stumble into the business to begin with?
Well, I'd have to say it started in high school. I had a small amount of money. My grandparents had left me, and I opened a brokerage account and started buying stocks.
Do you remember where you opened it at?
Oh, I think Southwest Securities. I really can't even remember at this point. And so that's when I got very interested in investing. Then, like you said, I went to UT, undergrad liberal arts, European history and Spanish literature, which wasn't a way to make a living. Then went on to get an MBA and concentrated in finance and investing courses. Just loved it. Graduated in 1983, which I should have looked up what inflation was and unemployment. It was a very bad time in the economy. And luckily, I landed a job at a savings and loan here in San Antonio, managing their whole portfolio of mortgage-backed securities. So it was on-the-job learning. That was pretty much a new industry at the time. All the big brokerage firms, Solomon, Goldman, Bear Stearns, were going around to local savings and loans, getting them to package up their loan paper into these mortgage-backed securities. And,
what year was that?
This was 83.
So the early innings of the financial crisis in the making.
Yeah, of the savings and loan crisis. And I quickly found that the only money the association was making was from trading mortgage-backed securities. It was just too hard to make money with the high deposit rates because of inflation. So I started looking around for a place to land, and luckily that's when I got my job at Austin, Calvert & Flavin, which was the largest RIA in town. And they were looking for someone with bond or fixed income expertise because they had primarily focused on equities.
What year is this?
86. Yeah, so that was in 1986, and it turned out to be a great learning experience. I learned everything about the RIA business, equity analysis, portfolio management, performance reporting, even trading. Our other partner, Sarah, was the trader at the time, and when she'd go on vacation, I'd take over the trading desk for a week or 2 weeks. And so I learned a lot there. And so then when Laura, our other partner, approached me about starting CrossVault, I came with all the expertise of an RIA. She came from the brokerage side of the business. And so we felt very comfortable putting, our experiences together to start an RIA.
So what year did she approach you?
The end of 1999.
So you're in the midst of the tech bubble?
Yes.
What was that conversation? Was it just, hey, this is my idea?
Well,
are you on board?
She had been wanting to move out of the brokerage business because of all the emphasis at the time of, they called it producing. It was a commission-based business. And she wanted to move to the RIA side where it was fee for assets under management, because that's basically how she'd been managing her portfolios all that time.
Yeah, and that's now the standard for the most part.
Yes.
So you guys were very early in.
We were early in that, and one of the precipitating factors for me was that my firm, Austin, Calvert & Flavin, had been sold to a large mutual fund manager, and so the prospect of ownership had gone away, and it was important for me to feel like I had some ownership in
some
developing
stake in the business.
Yes, exactly.
So tell everyone what your master's thesis was, because you told me this yesterday.
It was very exciting thesis on interest rate futures and hedging possibilities for the savings and loan industry.
So which is why you started out in savings and loans.
Well, I knew I was going to be working at a savings and loan, so I wanted to do work that might be of a practical bent for my job. And it actually turned out I did one of the first interest rate swaps for our association. That was probably back in 84, 85. So
I think of the investment management business, especially the technical aspects of the business, as a bro. I call it a bro business. It's male dominated. It's the 80s, so I can't imagine what it was like then. How did you navigate some of those dynamics, especially during that time period?
Well, I have to say, since my career was in San Antonio, it was much more gentlemanly. I think, Laura being in New York and Los Angeles had a different experience than I did. But to your point, yes, very male dominated. The time I got my CFA charter, I was probably a handful of women in the local CFA society here in San Antonio. And it's continued to be that way. Women are making strides in the advisory business. I know our partnership with Prime, they were happy. They wanted to add more women advisors to the company.
Yeah, I think it's definitely a breath of fresh air. Different perspectives, different temperament.
Well, I'd also say that research shows that women are very good advisors. One reason, we're very collaborative and we're never sure we're 100% right. We're always looking for other ways to come about something. And that's how our company's been run the whole time, very team-based.
Yeah, our macho egos tend to get in the way.
That's what the research shows.
Research backed. So you guys start the business in the early 2000s. What were those times like? How challenging were they? Were they fun? Were they scary?
Well, I'd say getting the firm started was one of the most fun and exciting things I'd ever done. Just the endless possibilities. And then you get the dot-com crash. Assets under management, the values are dropping. It's kind of a scary time, but we stuck to it and kept going and taking care of the clients. But, then we had 9/11, which was another real shock to the system. And when the financial crisis of 08, 07 and 08 hit, Laura and I were looking at each other and just going, well, we've survived the dot-com, the dot-com bubble, 9/11, we can take care of ourselves in the financial crisis.
So Sarah comes along in 2011. What was that conversation on bringing another partner in?
Well, we knew we always wanted another partner. We felt like having 3 partners is just more stable. When there's 2 of you, if something happens to one, there's one person kind of left trying
Pick
to
up the slack,
keep everything together. And I'd worked with Sarah for 14 years at my previous firm, so I was very familiar with working with her. So no surprise there. And Laura had known Sarah our entire lives. So, it just felt like it was going to put the firm on a stronger footing to grow, to have 3 partners.
And you and Laura had a very long relationship, so to speak, long term.
Since elementary school, we carpooled together.
That always helps the dynamics.
Yeah. No surprises there.
So the business grows. You guys run into a little issue called COVID. What was that like for y'all?
We actually didn't miss a beat. We got the heads up pretty early on that there could be some office closings, so we made sure we all had laptops, had the software if we needed to work from home. And it was very important to us to keep the office open throughout COVID. So we split the 5 of us into 2 teams and we'd rotate one team in every other day so that you'd have a day at home and then a day at the office. And
what were y'all thinking about investment-wise? I mean, you have 10% down days back to back.
When you've been in this business long enough, those are buying opportunities. They're rarely selling opportunities. When you look at the chart of the S&P 500 over the long term, these big market dislocations that you think are the end of the world, they're a blip.
Right.
As long as America is innovating and growing. And so we've always found it very important to talk more to the clients when things are bad to keep them from making emotional decisions.
Did y'all do any buying? Did y'all find any opportunities like on an individual basis, stock basis during that?
We did a little bit. It was so fast.
It was so
2
fast.
months. And most of that 2 months was, just spent talking to clients and, trying to reassure them that, things would improve as we got through the crisis.
Yeah, I recall the commentary at the time from the CNBC universe and all those professional networks they were calling for a move up in your quality. And in my mind, I'm thinking, I don't know if you want to do that. I mean, your more risky stuff is cratered. That's where the opportunities lie. And so from a stock selection perspectives, at this time I'm at Merrill Lynch, I started looking for opportunities in the non-stay-at-home universe. And it led to a really rough 2020, just from a temperament perspective, because, I'm making the investment decisions for the larger practice at Merrill. Everybody's seeing Zoom and Peloton and all the stay-at-home stuff just screaming higher. And, I started, I was thinking about it from a longer-term perspective, trying to just settle the ball and being like, look, like gym equipment ends up like any other gym equipment. It's a coat hanger.
Yeah. Throw out in the garage or...
Yeah, not to say that it's not a useful product. It's just, when the valuation says like, well, this is going to be the way we work out forever, it just didn't add up to me. When I saw, there was a moment, I'm actually writing about this now, there was a moment where Zoom's market cap was more than ExxonMobil's market cap. It was kind of a brief moment in October of 2020. And so, when I was putting money to work, I'm looking at Exxon and Simon Property Group and, that's the mall REIT. And I'm kind of getting a lot of slack for it. And then November rolls around and, they announce the COVID vaccine. Some of the initial trial results from Pfizer started rolling in. And I think they were from like South Africa or something like that. And regardless of where that vaccine stands today, it just led to a ferocious rally and just a huge rotation. Mm-hmm. And I think that was my best, like just from a performance month, like that was my best single month. But, I didn't do anything. It didn't do anything for the 8 months prior, but give me a ton of grief, and anxiety and heartache over, but I often think about like you guys have an active equity perspective. You always have. That hasn't changed even with the Prime acquisition. Have you guys had moments where you maybe second guess some of your investment decision making?
Of course. But we've had a long-term strategy. We stick to it. We try to look for things that we think are going to work for 3 to 5 years, not just the next 12 months. So again, to your point about what were we thinking about during COVID, We're like, well, this is temporary. What's going to work as we come out of this and life returns to normal? And who are going to be the big winners as life returns to normal? And so it's not really any change from how we do anything in a crisis mode.
Yeah, you guys have had and part of the reasons why I joined, or I was really excited to join, is that we did very much jive and that big picture perspective on how to invest. I think we see things in a very similar fashion. Why do you think the style of individual equity selection I don't like to use the word traditional, but it is very traditional. Why do you think that's fallen out of favor just in general over the recent? I mean, it probably started, it's definitely a post-financial crisis trend that I think is really magnified after COVID. Why do you think it's kind of people are losing faith in that approach? And the industry abroad too. I mean, it's really...
Well, there's always been this push-pull between active and passive investing. The ETF mutual fund model versus individual stock selection. I should say you can have active investing in mutual funds as well. But the reason we like doing it is we feel that by identifying individual companies that we think are going to grow their earnings and grow their revenue over the 3 to 5 years, it keeps you focused on what's really working both in the U.S. and globally. If you're just buying an index, I think you can get spooked out of your investments much more easily. If the market turns south and you see this index fund just dropping and dropping and dropping, you're like, why am I holding this? But if you're owning individual securities that you understand their earnings statement, their balance sheet, you can hang on longer and not make as many emotional decisions.
It kind of blurs the line from that view of you're investing into a company, an operating business, right? That's what you're really at the end of the day, that's what you're investing in, right? You're an equity owner in the business. Some of the commingled vehicles kind of remove that perspective, right? Maybe not directly, but just from a psychological perspective, you kind of lose that perspective. Well, you're investing in an underlying business rather than just this vehicle, right? I have always had, I don't say always, but I've come to this conclusion that we are all active investors. Whether you're choosing to invest in the S&P 500 via an ETF or you're choosing individual security, it's an active decision to choose to invest in a market cap index. Your manager is the S&P 500 investment committee. It's a momentum-driven index. The things that are doing well continue to go up, and you buy more of those with your incremental dollars. You buy less of what hasn't done well, and you remove the rebalancing mechanism. So I think as the market has become dominated by a handful of businesses, regardless if that's right or wrong, I think it's become very difficult for most of the investment universe because they hyperventilate about benchmarks, right? I think the professional fund community, active institutions, they hyperventilate about benchmarks. And so, that very act, it's like it's not a profession where you try harder to get better results, right? It's like you don't try to be a better investor. In my view, it's like you can do the fundamental work, you can look at the security, but you can't will it, and I think some of the industry has created the recipe to make it very difficult for other commingled vehicles, professional SMA managers to really outperform because you have to think differently. You have to be willing to buy a security that's maybe not in the index, or maybe buy a security that's in the very lower size quadrant of the index. And because everybody's hyperventilating about tracking error, they just don't do it, So I think it gives us a wonderful opportunity to, and we've experienced that this year, to identify businesses that maybe aren't on top of mind, and now all of a sudden they're all on top of mind. But yeah, it's just been a really interesting decade in that regard, and just how the industry has just, I think it's capitulated on active management in some ways.
Well, and as you know, I've been doing this over 40 years. Things come in and out of favor periodically. There's always reversion to the mean at some point. That's one reason why we've always tried to be a little contrarian in our thinking, because to your point, if you're just glomming on to the same stuff with everyone, eventually it stops working. And as we've seen, it stops working very painfully.
Yeah, and it could be rather sudden.
It can be sudden and very painful, and we've just found over our career avoiding those big downdrafts lets you come out of these periods of market dislocation and start improving the performance better if you don't go down as hard as everyone else.
Yeah. So COVID happened. When do you and Laura and Sarah start thinking about a larger partnership?
We started thinking about it, I'd say 7-8 years ago. We were all approaching 60, and we knew we needed to get some younger partners in the door. So we started, trying to look around for some younger partners. Did not make much headway. Part of it is what you're talking about. Most young advisors in the business didn't do individual securities. They weren't comfortable with it. It was always, ETFs or mutual funds. And then compliance gets harder and harder every year. Cybersecurity gets harder and harder every year. Insurance costs. We'd always paid for our employees' health insurance, and that was a huge overhead expense. And that's when we started looking around for a larger company to partner with to help solve a lot of these issues. We thought having a national company behind us would help us attract very high quality younger partners, which
Thank you.
We got you, John. Thank you. Wave at the camera. And by taking all the aspects of running the business off of our backs, because it was split between all of us. I did the books and the accounting and the insurance. Sarah was compliance. It's freed us up to spend way more time on speaking to clients and managing portfolios, which is, what's the most value add to our clients. Yeah. And it was a great decision.
It's all of the business and entrepreneurial aspects of exactly what you're saying that make any entrepreneurial venture so challenging, right? It's like the craft or the skill that you're trying to market is, what you're passionate about. Nobody's passionate about compliance and HR or health insurance. And it becomes kind of it's a monetary headwind, but it's also just a professional headwind.
Well,
because you could use that to better your skills.
It distracts you from your main goal, which is to manage your clients' money. I mean, it was a joke every year when the annual health insurance renewal would come around, and I'd be looking at the plans. Laura and Sarah would tiptoe past my office like, leave her alone. It's health insurance time. Oh.
So I'm sure you had a lot of suitors because y'all had a wonderful business. Why did y'all land on Prime?
Oh, well, that's easy. They're some of the nicest people we met. They also weren't the largest, and we felt like, we'd have a chance to, help grow the business. They said we could keep managing our clients' portfolios the same way, because when you think about it, we'd been in business, 23 some odd years, and we had a lot of embedded capital gains in our clients' portfolios. So if we would partner with someone who said you have to sell everything and then buy this portfolio of ETFs, that would not have been good for our clients. Our primary goal was this had to be good, not just for us, but for our employees and our clients. And so that was what we were mainly striving for. And it's been a great partnership.
Yeah, coming in, of course, after that's been completed and you guys have essentially merged or gone through the intricacies of that process. I get to come in after the fact, after that's done. And from my perspective, I'm like, oh, they allow you to run your business the way you want to run the business. And they're there to be supportive, and they've done just that. And, anybody can quibble about little things, but I think the general, support system has been pretty solid. It was a very easy
transition, and everything they told us, they delivered on. And like I said, everyone's so nice. It's so pleasant to talk to anyone who's in Overland Park. And it's been very interesting for me to see things they were talking to us about a couple of years ago about their vision for growing the company. They've been executing on.
Absolutely.
But what I think differentiates Prime from some other companies is, Glenn articulates this very well. He wants to be the best professional service company in the country, not the biggest,
right,
but the best. So you have to grow responsibly, which is how we built CrossVault. And the clients have been with us for a long, long time because it's worked.
Yeah, it's attracting clients is one thing, but then you actually have to do the job, right? And that's a whole nother thing, right? And you got to deliver on the commitments that you've made to clients, and not just 1 year, but every year. So I think Prime's done a good job of enabling us to do that.
I totally agree.
We've seen the industry shift, and we kind of talked about some of the indexation of markets and stuff, but those have been the other two focuses of the industry more broadly, is financial planning and private investments. Let's start with planning. Where do you think this big planning push has come from?
Well, I think some of it has been technology driven. The software now, you can do a lot with it versus, doing it with your pen and pencil. I think that's been a big push, but it's also, as investing's gotten more complicated, I think it helps people see this path from starting out. You get married, then you have kids, you're doing college planning, retirement planning. I think it helps keep people focused. We've always done a version of financial planning at CrossVault, but now with our partnership with Prime, we have access to the best financial planning resources available. And I really think it's much more important for younger people, our more established clients that have their estate planning attorneys and their CPAs. They've made their money or sold their business. They know they're okay for retirement.
Yeah, so I saw the transition when I was at Merrill, because the business, so I started at Merrill in 2012. The industry was starting, there was two trends that I saw. One was a trend to multi-person teams from the sole practitioner or sole producer, and the trend to fee-based investments, because a majority of revenue for your average advisor was still commission-based. And so as we talked about the professionalization of the business, not that commission-based wasn't professional, it wasn't the ideal version of what the business should be, right? Which is a unbiased individual or someone acting in the client's best interest rather than in the aim of earning a commission by selling a product. And so I saw this transition kind of take place, and it happened pretty quick. I'd say from like 2012 it began and then accelerated. And then I would say that was mostly done by 2017. And where most practices were fee-based, and the financial planning became a big focal point. And I would say the planning piece was superficial at the time. And I think it's evolved. You know, the CFP credential has become more common. I think more people are seeking that credential. And then you have the software, which makes, you know, everything more visual. And even though you do it on a one-page Excel, no problem, right? Mm-hmm. But now you have all these software resources that professionalize it. So what about the private investment kick? It's, about to step into 401ks. So it's about to get into retirement plans. The general partners, the publicly traded ones, the Blackstones and KKRs and Apollos and Carlyle, they've become main players or big players in just the financial services industry in general. So they got more staying power, that's for sure. What do you think about the industry and it being so widely adopted?
Well, it's still too soon to know, since they've just passed that rule that, smaller investors can, especially in retirement accounts, can do alternatives and private investments. Personally, I think you have to have a much higher net worth than most people think in order to do these type of investments. And again, it gets back to liquidity. The investments aren't liquid. You have to commit. So if it's a venture fund, up to 10 years, if not more. Private equity, I think they have a little bit shorter lifespan and return cash more frequently. But for smaller clients, especially if they're going to be living off their investments and you can't access it, and then if you have a market downturn and then you really can't access it, I think that can cause a problem.
Yeah, and everybody wants out at the same time.
Well, that is
and
the
it's
problem.
it's not when times are good.
No.
It's when there's some pressure in the system.
Reminds me, we didn't even talk about the crash in '87 because that was
that's right. That's not even in my purview.
Well, yeah.
I was 2.
You were 2. Well, I was starting out in the business, and I think the market was down 27% the first day, and maybe another 10 or 15 the next, before some of the big corporations started coming in and buying their stock, which put a floor on it. But the thing I remembered the most that day, besides the red screen and the stocks, is we had some clients trying to sell some treasury bills. They needed some liquidity, and it's the safest, most liquid instrument in the world. And we were calling up trading desks, and they're saying, no bid, no bid, no bid.
Because nobody has cash to buy. Nobody's buying.
No one knew what the price was because it was moving so quickly. They couldn't give you a firm bid. They'd say, I can try to sell it for you, but you'll just have to accept whatever price.
Yeah, nobody wants to take a bath on a treasury bill.
No. But so to your point, when things get really bad, everything is correlated.
Yeah, and then it's just liquidity profiles. I'm really mixed on the asset class as a whole. The pros for me are the shrinking float of the public stock market. The number of publicly traded U.S. equities has just been in decline. The Wilshire 5000 is no longer the Wilshire 5000. It's like 3,500 or something like that. I partly feel that the small cap indices, is just the Russell 2000, has partly turned into like no man's land because market caps are so large today. It's like, well, why haven't you graduated out of the Russell 2000, right? Like,
You must not be doing
you must
something
not be
right.
doing nothing. They're levered, they got too much down the balance sheet. It's a lot of small regionals, community banks, biotech. And so part of me thinks is like, well, the good stuff is staying private longer because there's just so much capital there. You like, why deal with quarterly reports and SEC requirements and all these things when you can just take private money and grow, and then when you're IPOing right into the larger cap indice or mid cap indice or something like that, where you're already above $2 billion in size. I mean, I don't know. I'm sure there's been some smaller IPOs, but I can't think of anything of note, because we had CoreWeave this year and Circle. Those are all fairly large. I don't know the exact sizes, but I don't think they were of the small cap variety. Pretty sure about that. So part of me is like, well, there's some real value in being able to access some of these private markets because they're just not coming public, and maybe that's where the value lies for some. But I think, like you're saying, it's matching the liquidity requirements. Some of these evergreen funds where they have quarterly liquidity options, and those have become very popular, right or wrong. I don't know. The drawdown structures, whereas you commit, just for the audience, you commit capital and that capital gets called down over a 3 to 5 year period, and then you're stuck in the life of the fund. Those have been extended. I think a lot of those have been extended beyond the 10 years. I think they're in like their second 2 year.
Yeah,
They're in 14-year
when you read
term.
the account agreement, there's always a 2-year extension.
And sometimes multiple 2-year extensions. So I think some of those are in that second 2-year extension, or some of those vintages. I may be speaking just maybe too broad, but you start thinking 14 years, that's a long time. And are the marks accurate? I say that because I'm sure some of these funds, if they could get out at the valuations are printing in their books, they would get out, but they can't. Right.
Well,
and so are the
much
valuations right?
It depends on, the public markets. What's the exit strategy? Are IPOs popular or not right then? So that's why my main caveat has to do with how does this fit for the client and their liquidity needs and their cash flow needs.
Ego driven, but sometimes I think, well, a dollar allocated away would be a dollar that we don't get to deploy into an idea, an opportunity on our end, which, it's liquid. You can get the money out, that's for sure. And ideally there's really good results, so yeah, it's kind of a mixed bag. So we got it all figured out today.
Yeah, I'd just like to encourage more women and young people to get into our business because it's exciting, but there's also the aspect of you're helping other people. So it feeds that part of your psyche that, wants to be a positive.
It truly is a service business.
Yes.
It truly is a service business. It does feel good.
Yeah.
It does feel good when you're helping people and there's a good result on the other side.
Yes. Obviously it's financially rewarding. So I hit the microphone. Financially rewarding if you do your job well, but I really want to emphasize that service component of helping your clients.
Thank you, Marilou. All right, we had fun.
Thank you.